Now let's bring in George Tsilis, senior markets correspondent here. George, we're talking Nvidia. Shares are up 65% this year, in addition to the massive gains that we saw last year. What's your take here?
Well, my overall take, I think the stock is still cheap. I know it's sort of counterintuitive to think that's the case, even though the run-up this year has been tremendous. It just continues to move to the upside. If you look at the last report, when they reported on the 21st, about 10 days or so ago, looking at the reaction after hours, it looked like there was potentially a profits plateau or profits growth plateau, but that wasn't the case as the numbers were digested and the earnings, which did beat the estimates. We're talking over 400% earnings growth compared to the same quarter last year on sales. That was up close to 300% year over year. But the guidance also, and I think this is where Wall Street really got it wrong across the board, was if you look at the earnings per share guidance for 2025, it moved from $21.50 to $24.60. So Wall Street had it wrong from the standpoint of forward earnings guidance, and then subsequently, once those numbers started to manifest, the stock just continued back to the upside. Even though going into earnings, the stock had made a nice move, and some had thought maybe there was a plateau, but that wasn't the case, as it just continues to break higher and continues higher.
George, give our viewers a 30-second talk on why the stock is going up and the PE ratio is going down here.
Well, it's because earnings, that's the thing. Earnings, again, were so under anticipated that forward earnings right now at around 32 times, it's just any cheaper and cheaper. I go back and look, about 4 quarters ago, it was trading over 60 times earnings. So this is the case of, well, price is moving very aggressively, but earnings are moving faster on the rate of change standpoint. You just look at, looking at last quarter and compare those numbers year over year, 132% earnings growth estimates based on the numbers that we've actually seen compounded going forward. Now you look at 32 times forward earnings, that's cheap. If you look at, for instance, Microsoft, I'm going to give you an example of another mega cap everyone's familiar with. That company's stock is trading around 30 times forward earnings, but their earnings growth forward basis is at 15%. So it's almost as if Nvidia is growing 8 times the amount of Microsoft in terms of earnings, and its multiple is only trading around 1 or 2 points more than Microsoft. So that's the thing. Even though it's gone up so much, the earnings continue to impress. And essentially, the other thing you have to keep in mind is it's not just hardware anymore. If you consider what they've talked about, it's this Omniverse cloud. It's essentially NVIDIA software as a service. And this is going to become such a mammoth ecosystem alongside their GPU hardware that it's going to be hard to switch to any competitors. And I think AMD, you guys mentioned AMD earlier, I think AMD is obviously the second best competitor. That stock has been performing well, and I think it has to do with the fact that NVIDIA's chips are hard to come by. They're very expensive, and AMD's chips are easier to come by. Their technologies are improving, but still not as good enough or as good as NVIDIA, but certainly good enough.
Yep, watch that earnings in the PE and also those partnerships moving forward.